Let's begin our outlook for the week. As far as rates go, I think the market really has gotten the Fed's message over the last couple of weeks. It continued on into this week. Have a look at those capital market rates. The change since the beginning of the year, all the way out to the 5-year now, are actually higher on the year. The 10-year is only down 6 basis points. Compare that with a couple of weeks ago where the market had cut interest rates on the 10-year by a little over 40 basis points as the Fed was saying we're going higher. The market was cutting rates. Well, I think they're all on the same page now. The next FOMC meeting is March 23rd. That's in 31 days. And in the past week, both Bullard and Mester mentioned that at the February 1st FOMC, they both saw a case to raise rates 50 basis points, not 25. So if we look at our probabilities at the bottom of the screen here, 25 basis point hike is now down to about 82%. There's an 18% weighting on the 50. And I put the progression in the brackets here. You went from 99.6% down to 90.8%. Now we're 81.9. This is week over week. And the 50 went from almost nothing, 0.4%, to 9.2, is now 18.1%. But before we get the decision on March 23rd, you've got one PCE report coming up this week, which usually it follows CPI but below CPI because it has a much lower weighting for owner's equivalent rent. You have one more jobs report and one more CPI report. If that CPI report comes in higher than expectations, or comes in, as they say, hot, or is just not showing any decrease, then I think you're going to go 50. But failing that, I think you're probably looking at 25. I think they'll probably signal that we're going to stay at 25. There'll just be more 25s because they're still going to focus on the cumulative effect of everything they've done and let that begin to work its way through the system. Going 25 at a time might be psychologically enough to back people off of higher credit, more hiring, things like that. So I'm not quite sold on the 50 as of yet, unless there's a compelling reason to go 50. Failing that, I think you'll see 25, but a signal that no, there isn't one or two left. There may be 3 or 4 more left. So with the March meeting, we also get the summary of economic projections. We're going to get a new dot plot, which sets out, from the dot plot, we find the median rate at each meeting where they think the rate is going to go. We can start to look at what they see as the terminal rate at the end of this year versus next year, what the high level on that rate is. We get the minutes of the last meeting in 3 days. Based on what Mester and Bullard said last week, I think it's going to be rather interesting in the meetings, because I think the market was expecting that within those meetings, the conversation about the pause would have begun. When do we start pausing? But with 2 of them saying that they saw a compelling case for 50 basis points, the conversation might have been more towards 50 versus 25, not 25 versus pause. So I think that there'll be some interesting comments there. I'll put a separate video up just for the minutes, because going through the minutes, and I encourage everyone to read the minutes, every word on them. I highlight certain things, but it still takes half an hour to go through the minutes and read the important things, and then you add your narration and you editorialize as you read. So I'll put a separate video up for that. Next week we got some Fed speakers, not many: Williams, Bostic, Mester, and Jefferson. Fed balance sheet. After a pause last week, there was no change because nothing matured. You had 33.27 billion come off. Total now is 7.8895 trillion. Versus 7.992 trillion. Hardly looks like it's moving, right? I don't even know if we need to put that number up every week, because in 4 weeks it'll still be 7.799. It'll still look pretty high. 32 billion was all U.S. Treasuries, 1 billion in mortgage-backed securities. In the money market, for money market rates, February 17th, February 14th here, during the past week, you had money market rates all hitting new highs, consistent with the message the Fed is delivering that if you think we're going to 5% and stopping and then cutting rates, you're wrong. So the market is starting to think that when we get to the Fed funds futures, that 5.25 to 5.5% seems to be where they're targeting for midsummer. That we'll get somewhere between 5.25 and 5.5, which is 3 more hikes of 25 basis points. Not 1 more and we're done, but 3 more. So these all hit new highs on the way in. Slopes, the 2 to the 10 year still inverted, 228 days now. And the 3-month to 10 year, the capital market to money market inversion, 116 days. And it did rise a little bit, but not enough to say, oh, okay, it's being fixed. The 3-month rate, 18 months forward minus the current 3-month, inverted 100 basis points. I'm using 3-month SOFR to get this done, using the forward curve on SOFR to get that done. That will, I think, hold very closely to where the 3-month rate is. This is at 482. SOFR's at 484. SOFR's at 482. It's very, very close. Inverted 100 basis points versus just negative 96 the week before. The effective federal funds rate, 4.58%, which is right in the range of 4.5 to 4.75, closer to the 4.5. The reverse repo increased by 16 billion, still over that $2 trillion mark as we get more balance sheet runoff. And if there are not enough coupon paying bonds, they let T-bills run off. Well, as you get more of these running off, it takes the Fed out of that particular market and allows more movement in, as opposed to using the reverse repo facility, because you're getting 4.55 over here, but you can get 4.64 on a 1 month, 4.81 on a 2 month. And the volatility of rates has dropped, although it could increase depending on how the market sees how high the Fed will go. You could get more volatility coming into rates, and if you do get more volatility, you will get more pickup over here, because this is money that really can't take or will not take any price risk. Well, you know, even if you're in a 2-month, you do have from day to day some small little price risk. It does exist, although it's small, but if you can park money for a month or 2 months, it's better. For this to come down, you're going to need some clarity on when the Fed is going to be on hold. You're going to need the volatility of rates to drop, and you're going to need more runoff on these T-bills. June. Let's look at what's going on for June here and how this has really changed, because we have a March meeting, a May meeting, and a June meeting, and this is starting to price in 25 basis points at each of these, which would bring us to the upper end of the range at 550. Look at the weighting on that now, 53%. 5% is almost non-existent. That is saying there's one more rate hike. That's almost non-existent. Dropped from almost 10% down to 2.7, ending at 5.25%. That seemed to be the consensus. Well, that is now only a third of the consensus, 34.4. The weighting is on 5.5, and even 5.75 is getting a lift at 10%. Went from 3.4 to 10. The week before it was, I think, 0.1%, jumped to 3.4, now to 10% at the 5.75. I've even heard 6%, and that is from a previous Fed official. It was on Bloomberg. Who was it? And the name just escapes me. As soon as I'm done, I'll remember the name, but that it could go as high as 6%, and the market is slowly getting the message at 5.5. The bond market and the money market, Fed funds futures market, are all sort of coming together and agreeing that, yeah, you know what, there's something there. Let's start paying attention to this. The equity market just doesn't seem to want to adjust the cost of capital, though. Real yields all have increased. Not much, but they've increased. And nominal yields increased by more, so that puts the break-even rates at a higher level. But if we're thinking about valuations, real yields are the more important component to look at, as I explained in the interest rate tutorial video a couple videos back, explaining why all these numbers matter and why we need to pay attention. If you're discounting risky cash flows, changes in real yields matter more, because your numerator will have an inflation component in it. And if you use nominal rates, the nominal yield has an inflation component in it as well. If you get rid of them, you have real cash flows discounted by real rates. So the real rate is the one that will affect valuations more. And of course, break-even rates are just, a little bit higher. Not a lot of move in the real yields and break-even rates over the course of the week compared to what nominal yields have done. Here's the more interesting story in the Fed Fund futures curve, is the message from the Fed is finding its way into this market very quickly. Last week, the index was bottoming out in August at 94.82, implying a federal funds rate of 5.18. We know the index is 100 minus R being the effective federal funds rate, 5.18. So that implies a policy range of 5 to 5.25%. What a difference a week makes. 94.705 on the index, implying an effective federal funds rate of 5.295, an increase of 11.5 basis points for the week. That puts the policy range at 5.25 to 5.5, because you are over the lower bound of 5.25. If we go out to December of 2023, last week, bottoming at 95.025 for an implied rate of 4.975, all the way down to 94.87. So December is sitting at 5.13. That's an increase of 15.5 basis points for the year-end terminal rate on the effective federal funds rate, up 15.5. The implied drop from the peak to December, 5.295 down to 5.13, is a drop of 16.5 basis points. At one point, this was a drop of 50 basis points. And this is when the rates were bottoming in May, June, July. They were kind of hitting a low across those 3 months, or the curve was hitting a low before heading up into December. That's suggesting that the market thought that there was maybe 1 or 2 more rate hikes. The Fed would be on pause for a couple of months and then start cutting rates, 2 rate cuts by the end of the year. And I thought that didn't make any sense. There'll either be no rate cuts, higher for longer, or a lot of rate cuts because of a recession, but 50 didn't make any sense. Well, we do have the higher going on. We went from 5.18, now we're 5.295. If you go back 3-4 weeks, we were 4.75, 4.8 on the implied rate, all the way now to almost 5.3. There's the higher. And we've moved from the curve bottoming out in May, June, July to now bottoming out in August. And I think as time goes on, we'll see this stretch out to maybe September, bottoming out in September and flattening out into December if we get no recession. If we get a recession, you're going to get this curve moving up dramatically, and something like that happening, these rates will really move up. So, for the December Fed Fund futures contract, I am long at an implied rate of 5.01, which means 94.99 on this one. It purely is a recession play. It's not because I think the market has the Fed wrong. I think we have to believe the Fed when it says higher for longer. It is going to stay higher for longer unless there's a recession. And if there is a recession, something's going to show up in credit markets. It always does. And we're already, or I don't know, I have already found something that to me looks like the beginning of something. I said if there is going to be a credit market problem, it's probably going to show up in private credit first, because the growth there was phenomenal. It's probably going to show up in private credit first. And I did find something on my newsfeed. I saw a story. I thought, well, let me read this. And I read it. I go, this is super interesting. This is exactly what I think is going to happen. So thinking might be, well, if it's private credit, it's contained to the private credit market. It's not public. These things have a way of spilling over. Go back to 2007, Ben Bernanke testifying to Congress about the subprime mortgage market, saying that he believed at that time that any problem in the subprime mortgage market would be contained to that part of the market and would not spill over into the broader market. The guy who should have known didn't know. These things have a way of just having this contagion effect that spill over, and I think we're seeing something. So I'll share that story with you. But my long position here is purely a recession play, because if we're going to end at 5.5, if that is the upper range, the implied federal funds rate will be between 5.25 and 5.5, call it 5.375. My average is 5.01, so my worst case scenario, I think, is a 36 basis point loss per contract, multiplied by, well, what is it, 4,167 per contract, so 36% of that times the contracts that I have. But that is a recession play, not a play on the Fed. I want to be very clear about that. Looking at the 1 year rate, 1 year forward, negative 80 basis points. That is looking at the 1 year, the yield on a 1 year treasury 1 year from now. We'll be yielding 4.2 and we're at 5. So implying 80 basis points cuts over the next 12 months. This is saying 16.5 to December. And if we go through the full year of 2024, December 23, December 24, using 1 month SOFR, 143 basis points lower. Last week was 151. We're slowly squeezing it out. This here hasn't moved much, 78 to 80, but 151 down to 143. And as we continue on and the long end of this curve starts to drop, I think you'll see this get squeezed out as well. For those that have the applied series, as I mentioned, the extra this week deals with retail sales and with Loretta Mester. In her speech, she talked about 2025 as being the year where they see inflation hitting their 2% target. 2025. If you get no recession and they keep rates higher for longer, that's implying 2025. All of this has to come out. Can you imagine another 24, 25, 26 months of this? Oof, it's a lot of work every week. TLT is down 1% week over week. SPY only down 0.2. I got to put a question mark on that. The fixed income market seems to be responding quite well to the message the Fed is putting out there, but the equity market just doesn't want to seem to give up the ghost. Implied volatility coming back in, 13-week implied volatility at 21% versus 15%. I am short on TLT, the 104 puts for March. For March expiration, I did sell the 104 puts. And on this day over here, I bought 15 more January 2024 110 calls. I think I paid $4.20 for each of these calls. So I have 55 calls now for January, the 110 calls. I am trying to get all of them for free. My average price is, I'm pretty much at my break even. My break even, sorry. 420 basically was the break even that I have on the original ones that I bought, considering everything that I've worked off so far. I do try to get these free whenever, if I'm buying any calls, long-term calls, I will work the options to see if I can get them all for free. That's the goal. I also sold options on futures for ZB for June, the 126 and the 124 puts. I got 3.5 roughly on the 126s and 2.5 roughly on the 124s. So as they were dropping, I was selling these puts, which would put my put price on the 126s at 122.5, and on the 124s would put me at 121.5. My bet here is short term. And my thinking is that what we see over here, I'm just going to circle this part over here, is the pricing in of what we've learned last week. Both Bullard and Mester said they saw a compelling reason to go 50 basis points. The Fed funds futures is suggesting a 5.25 to 5.5 peak rate later this year. So that is all observable and in place. So I think the bond market has responded to all of that. Before the next meeting, we're going to get some more data points. PCE this week, which really I don't think is going to change any view that anybody has, because it usually has a very high correlation with the CPI, albeit at lower rates, because it has a much lower weighting on the shelter component. You get one more jobs report and one more CPI report. And my bet is that the jobs report we saw earlier this month for January was an anomaly that sort of conflated two things going on. Number one, I think that there is some seasonality in the numbers because it is not a typical business cycle. I think that there is some issue with the seasonal adjustment there. The other is that January, throughout most of North America, was probably one of the warmest Januaries. I don't think I shoveled snow. Yeah, no, I did shovel snow once. It was like an inch of like powdery snow. I bought a snowblower before winter began, thinking, well, there'll be a lot of snow this year because that was sort of the forecast. It'll be a heavier, snowier winter. So I bought a snowblower and used it once, and that was it. Used it just once. Who knew that my purchase of a snowblower could eliminate snow? Had I not bought it, I bet you it would be sitting under 6 feet of snow right now, shoveling every day. My fault. Anyways, being that it was one of the warmer Januaries, a lot more people were probably out shopping. A lot more people were probably out on the weekends. That would explain retail sales being so strong. And if that's the case, well, you need more people working. So there could have been a weather effect that is not captured in the seasonal adjustment. There could have been a weather effect in there as well, because you could also, in many parts of northern U.S., continue home construction as well. So it could have been something along those lines. I think that when we get the March jobs report for February, it will come back in line, and that will give the bond market, some good news, thinking, oh, okay, the labor market isn't as strong as what the January report says. Maybe there isn't 3 more rate hikes. Maybe there's only 2 more rate hikes. And I think that there could be a rally off that. So that's what this is for. It's just a quick grab for these premiums. But my TLT trade is a duration trade. And if you're making a duration trade, you want as much duration as you can. TLT has quite high duration. And the Fed funds futures trade here is a recession trade. A duration trade is a recession trade because in a recession, rates drop really fast. Duration pays off really, really well. That's what these things are. I am not betting on a dovish pivot from the Fed. That's not going to happen. If there is a change in policy at the Fed, it's going to be because there's a change in the credit market. Not because there's a change in the equity markets, not because there is a slight increase in unemployment and maybe some negative prints on some economic data for a while. I don't think they're going to move if inflation isn't where they want it to be. I think they're firm on that. I believe them when they say that's what they're going to do. I believe them when they say this may cause some pain, that they're willing to live with the pain. I believe them, but the one place where they have the put is the credit markets. They won't hesitate when it comes to the credit markets. And I'm going to show you this story in a little while. That's my bet. That's what's going on there. In the meantime, understand that I am short beta. And I added to my short beta position this week. I am short beta and I'm long duration. And right now they have a positive correlation. So that when rates go up, duration suffers. But I win on beta because I'm short beta. So I do get some benefit from being short beta. So my portfolio volatility as a result of this ends up being very low. But if I'm right and there's a recession, the markets are going to drop. Beta is going to pay off nicely. This correlation will turn negative. Duration is going to go up. Or duration will benefit me because interest rates will go down. This side will benefit me. So my long duration will pay off nicely in a recession. My short beta will pay off nicely in a recession. That correlation will turn negative. That's the big payoff. In the meantime, they offset each other to some degree, and I get to pick and choose when I want to take profits on one side and add to it, or when I want to take profits on the other side and add to it. So I'll pick away at profits here when they show up. I'll pick away at profits here when they show up. But that is just a management. Those are just management trades of the bigger trade, which is the recession trade. And if the recession trade doesn't show up when I want it to, I roll forward. I just keep rolling forward. The OAS, our option adjusted spreads on credits, hardly any movement at all. If we're going to look for any kind of movement, it's in high yield, 19 basis points there, 21 here, but not a lot of interest in triple C or lower. You'd think that that's where it would show up first, right? But spreads widening on double B, 7.95%, and only 1.1% on triple C. Kind of makes you think, you must have different market participants going on. So you must have some clientele effect in each of these where they're just not paying attention to each other's markets. But overall, pretty muted. Yeah, they're going in a direction that says, okay, we're getting a little bit more cautious, but not to a point that we would be concerned. If we look at where all of the highs are for the cycle, you're going all the way back to July over here and October. This one here is also July. This is September. And we're quite a distance away from some of these. You're looking at high yield sitting at 4.24. Under 5. 500 basis points is about the average. You're sitting at 4.24. A high was 5.99. Recession levels are, once you start getting over 800. So these are a long way from that at this point. If we look at the yields, these are yields, these are the spreads. This is what we have up here are just the OAS, is just the spreads. These are the yields. This is including the risk-free component on top of the risky component. A 6-month yield, 4.99 on a treasury. A 1-year treasury is 5% versus 5.41 on investment grade. If we look at the 1 to 3 year investment grade bucket, it's yielding 5.38, just 38 basis points higher than where the 1-year treasury was, but it's moving in the right direction to reflect risk. Last week it was 31 basis points. Mortgage rates are creeping up, and what are we seeing? We're seeing mortgage applications drop. Housing is the most interest rate sensitive sector. So if we're looking for the effect of interest rates on consumer behavior, housing and autos typically are the two big sectors where it shows up first. Distorted this time around because of supply issues. There just simply is a lack of housing inventory available. And same with auto manufacturers. They're producing as much as they can, but at recessionary levels as it is. So it's not really showing up in the auto sector as much as housing, but we are getting interest rate sensitive, as we move away from the 6% range upwards. Mortgage apps were down 7.7, refis down 12.5, purchases down 5.5. It could be that the good news we saw in the housing market in January was related to the weather. I mean, when it's on a weekend, if it's close to freezing and it's, icy rain or snowing, you're probably not driving around looking at open houses. But if it's sweater weather, yeah, why not? Let's grab a coffee at Dunkin' Donuts. That's the U.S. And here it's Tim Hortons. But let's grab a coffee at Dunkin' Donuts and let's go look at some open houses. So maybe that the weather had something to do with the housing market in January. 6.32 on a fixed rate mortgage, up 20 basis points. And this is one day. This is as of Thursday. So if we're looking at the spread between the 10-year and the fixed rate mortgage, we have to back up to Thursday and look at the change week over week, Thursday over Thursday, up 12 basis points. The 30-year fixed rate mortgage is up 20 basis points. So the spread is widening on this, up 8 basis points. That should put downward pressure on mortgage REITs, or at least not upward pressure. So we should see that week over week mortgage REITs were either flat or slightly down. National Association of Housing Builders, the housing market index for February came in 42 versus 35. That is a big jump upwards. That's a diffusion index, right? Anything under 50 is contraction. Well, look at where we're moving to. Building permits in January up 0.1%. The previous month was 1.337 million. This is 1.339 million. Housing starts in January down 4.5%. That's month over month. So there is the question here that if the weather was that good, wouldn't more houses have been started, right? So, that kind of takes away from that thesis a little bit. 1.309 million versus 1.371 million. Or it could be that, well, if you're not building houses to spec, in other words, you're just building houses to order, then all the speculative building is out of this. That might make sense, even if the weather was nice. Unless it was sold, you're not gonna cut ground. Maybe. This week we get existing home sales on Tuesday and new home sales on Friday. All right, here's the story I was telling you about. In Interactive Brokers, when I click on Newsfeed, you can click on Portfolio News, and it will look at what you're holding and try to feed you news that is related to the sectors that you're in or the companies that you're in. And this one came across, and it had all the right words. You have an auto parts with bankruptcy and rising interest rates. Auto parts maker and bankruptcy probably wouldn't have gotten my attention. All three of them together got my attention, so I clicked on it. Standardine filed for bankruptcy Thursday, saying it had been crippled by the rising costs of variable rate debt owed to top creditor Cerebus Capital Management. It's important to know, I don't know this company. I don't have any, I don't know if it's publicly traded or not. Never heard of it before, but okay, I still wanted to keep reading. I know who Cerebus Capital is, so we're dealing with private credit here. Interest rates on the auto suppliers, $273 million in debt, have risen to a percentage in the teens. So you've got to get to at least 13 to get into the teens. It doesn't exactly say what number it is. According to a sworn declaration by Chief Executive Officer John Pinson, with potentially more rate rises on the horizon as benchmark rates rise. I want to combine that with this statement down here, so we're going to come back to that. Standardine can't keep operating with the current debt load and filed for Chapter 11 protection to get breathing room to reorganize as a financially stable business. The company has $3.8 million in cash, has been negotiating with Cerebus since November. Cerebus is not going to comment. Well, not really. That's a sort of a duh. Of course they're not going to comment. Standardine designs and makes fuel injectors, pumps, and other parts for diesel and gasoline internal combustion engines, serving both the OEM market and aftermarket for everything from passenger vehicles to tractors and utility vehicles. Roots date back more than 140 years. So it's not as if this is a 10 or 15-year-old company that just never really got a good footing in the industry and had maybe precarious market share, never really got there. Dating back more than 140 years. 468 employees working in states that include South Carolina, North Carolina, Michigan, all car regions. Also has affiliates in Italy, United Arab Emirates, India, and China. It says it made nearly $100 million of capex in its manufacturing plant since 2014. So this is not a small little operation. It's significant enough. Liquidity is running so low that if Standardine had made all its required debt service payments in December and early January, it would have run out of money. Mr. Pinson said debt service obligations this year are expected to reach $39 million, a number that is simply unsustainable. Supply chain interruptions, including a global chip shortage, also cut into revenue. So, I ask, at that point, well, how much of this is a revenue problem and how much of it is truly a credit problem? You may not have a credit problem, but if a revenue problem shows up, you suddenly have a credit problem. So, can we pull this apart somehow? And I don't think in the end it really matters too much how long I stay on the idea that, well, it could be revenue related, that if the revenues were higher, they could have made it, because if you're sitting in the mid-teens, that is a crippling interest rate to begin with. And I doubt if this is just one company that has this. And the rest is just, sort of a few legal sentences here about the secured, unsecured creditors, who the law firm is, and what judge is assigned to it. So this is sort of my thinking on this one here. When I take this potentially more rates on the horizon and this paragraph here together, and the timing of the bankruptcies just recently, we're February 16th here. So for at least a couple of weeks, they were thinking that, well, this is where we're headed. Let's prepare and get everything ready and let's get that done. Had the market unfolded differently, let's say that the last 2 weeks didn't happen and that there was a really good faith belief that the Fed at their February meeting was done, that we are actually done raising rates. There'll be no more rate hikes on the horizon. Would this have still happened? Because with potentially more rates on the horizon, would this have still happened? So I think, okay, so there's scenario one is that we're done. However, if you move to scenario two, where you're saying no, there'll be another 75. How many Standardines have moved? How many other companies are saying, okay, that pretty much does it for us now? If we're going another 75 basis points, that's just going to be a step too far for us. Because they said that they had been negotiating for some time. Since November, they had been negotiating. So they did see that they had a problem on the horizon. But it was only in the last couple of weeks that the potentially more rates on the horizon really became a reality. So was it that, look, it was inevitable, we would have gone to bankruptcy anyways, or was it this thing over here, potentially more, that really sealed the deal for us? That at that point we said, okay, well, we're already at the precipice. If we're going higher, we're done. So we may as well just pull the trigger now. That had the story stayed that we're done, would Cerebus have then said, yeah, okay, that's not going to affect our cost of funding, because I'm sure Cerebus has a cost of funding as well that they have to pass on, that if it wasn't going to affect their cost of funding, maybe they could have found a way to make a deal, and the company, Standardine, could have said, as long as interest rates don't go any higher, if they start coming down a little bit, that can only help us out. We might squeak through uncomfortably, but we might get through. Maybe if we cut costs 10% of our labor force, maybe, or 5%, or maybe lower management bonuses, but we could get through. But if you add that on, then we're done. How much more of that is out there now that this is becoming a reality? That's the important thing. Yes, this is a messy story because you have some revenue that is mixed up with credit. Is it revenue that's causing the credit problem? In part, probably, but when you have credit that is costing you in the teens, and the central bank is saying we're going higher, how many more stories are there that would have thought they were in bucket one are now going to move to bucket two? So I think that this is more than just, oh, poor company, sorry about their luck. I think this is, well, that's interesting. I think this is something, a powder keg inside the private credit market that might become a bigger thing. So if I were looking for where credit stress is going to show up first, it's going to be, I really believe it's going to be in private credit, and this kind of stuff is never contained. It has spillovers. Okay, retail sales came out this last week. If you have the applied series, there's a little bit more on retail sales in there. But a pictorial, there's November. Again, negative, eh? There's December. Remember all the negative signs we saw? Well, look at January. A couple of things going on in January. As I mentioned before, the weather. The weather was really nice. Think about the weekend. If it is, 25 degrees, and I'm speaking in Fahrenheit here, for my Canadian friends, that would be like negative 5, negative 6 degrees Celsius, and it were cold and blowy and snowy, you're probably not running to the mall. But if it's a nice day out and you could put a sweater on and head out to the car, you're more likely to go out to the mall. So there is some weather effect that happened in January, I think. The numbers were quite significant. Let's just read down here. Advanced estimates of U.S. retail and food services. When we talk about this category, we're really talking about durable and non-durable goods, right? And food services sales for January, adjusted for seasonal variation. Seasonal variation is the time of year, not the weather. And holiday and trading day differences, but not for price, meaning that we're not adjusting any of this for any prices. $697 billion, up 3% from the previous month. That's a big number, up 6.4% above January 2022. Total sales for the November 22 to January 23 period were up 6.1% from the same period a year ago, and the November to December percent change was unrevised at down 1.1%. So there is, because it's not adjusted for price changes, there is a desire to adjust it for changes in price. And David Rosenberg says you also need to adjust it for changes in population, because this is, if your population is growing, well, then your retail sales would just grow because of population growth. That doesn't mean people are buying more. In fact, you could have population growth with people buying less and still have retail sales going up. So he's saying you have to adjust it for population. And there should be some adjustment for changes in price so that we can get an idea of what the real trend is. I'm going to say to you, no, you cannot do that. But on a very naive basis, let's control it for CPI. Year over year, on January 22 to January 23, it tells us 6.4%. We see that in the narration below. Well, that was, if we look at CPI year over year, was 6%. So the change in quantity is 0 if we look at it over a 12-month basis using CPI, using headline CPI. If we look at it from the November to January period, it says that we were up 6.1%. The CPI was up 3.96%. So real quantities, change in quantity is up 2.06%. And if you just look at the December to January period, the change in price was 0.517%. The change in retail sales was 0.2963%. It says here 3%, but I actually put all the decimal places in. So the change in quantity is up 2.43%. So 12-month period, no change in quantity. If you just take a 3-month period, 2% change in quantity. A 1-month period, up 2.43, you would say this is showing momentum in sales. However, in the applied series, I have a little bit more on this. I will demonstrate to you that you cannot deflate retail sales. By any inflation metric, you cannot deflate retail sales. It's a flawed exercise to do. Retail sales must be seen nominally. And as far as changes in population, the answer to that is who cares? Who cares? David Rosenberg is conflating a micro variable with a macro variable. At the macro, we don't care. At the micro, he might be thinking about in terms of per capita. We don't care about per capita. It is meaningless. So if you have the applied series, a little bit more in there on that. Okay, let's get to SPY. Then we will look at the companies reporting this week. Then we'll look at the economic calendar and we will be done, but we'll spend a little bit of time here because I've changed my position and I want to make sure that I convey to you exactly why I'm doing it. so that you understand what my motivation is. You don't have to agree with me. I would strongly suggest that if you don't understand the points I'm making, don't copy me unless you're capable of absorbing the loss if you are wrong. But if you find some support in your belief with what I have to say, well then that's good. Our forward 4-quarter earnings estimate is 220.16. I didn't think it would change that much. There were only 60 reporting last week. From 220.30 down only 14 cents, and we have 59 reporting for the week coming up. I don't know that it's going to change too much from here. Closing SPX was 407.909. That puts the forward multiple at 18.52. It is important to point out that this price here, 407.909, is a fact. You can't argue with that. It is a fact. It's what we can see, but this is simply just an estimate. So estimates always come with variability, and variability is not one-sided, it is two-sided, which means that sure, it could come in higher, but it can come in lower. As we get better information, we get better forecasts. The original forecast for 2023, if you go back to last year, were as high as 249, and this is all the way down to 220. So as we start moving into 2023, that could move down to 215, it could move down to 210, it could move up to 225 or 230. It is the middle of a distribution. That is what the average of the estimate is. If we assume some kind of normal distribution, the average is the mean. It is the middle of a distribution with variability, because I'm asked as to why do I compare it with different yields, the earnings yield with different yields, is because to compare based on price and expected return, we would have to assume an equilibrium model, which means that the market price is correct and that there is some expected return that is the middle of a distribution. But what if the market price is not correct? What if the distribution looks like this, and there is the expected return, and the market price is over here? Well, then the expected return has to be negative to be able to get it to the expected return that is the middle of a distribution, because the market price is too high. So looking at yields gives you some relationship that you can look at in the past and say, well, what were the spreads between these yields? These tend to be very mean reverting as well, so there is some usefulness in looking at these. So this is an estimate. That's all that is. So the 18.52 becomes our best estimate of what we have now by considering what all the bottom-up analysts have said. These are people who know each of their particular companies, and you take the consensus bottom-up estimate for each company, and then you add that all up, and that'll give you the consensus estimate for the market as a whole, which is 220.16 on an operating earnings basis. That means anything below that, the non-recurring stuff, is usually forecasted to be zero. And the date of this is of February 15, 2023. When you download the spreadsheet from S&P Global, if you look in cell D117, it will tell you the date at which that estimate applies, so we know what it is. 18.52. Now at the very bottom here, I have a simple decision tree. I've got the no landing in there as well, because in the last couple of weeks that has sort of become part of the narrative. It's like, well, hang on a second. Why does it have to be soft or hard? What if there's no landing? What if we don't have a soft landing? What if we just keep growing and growing? I put less than 5% probability associated with that, because if you have no landing, you're not going to have inflation bleeding away on the services side. And as I've already explained in yesterday's video for CPI and PPI, with the energy supply curve and the labor supply curve extremely steeply sloped, it doesn't take much before you start seeing inflation come right back into the numbers. So if you want a no landing scenario, higher for longer, you need a higher cost of capital. Liquidity will continue to be drained from the system because central banks will continue to raise rates, and balance sheet runoff on central banks will continue as well. So that does not sound like the environment on which I would create a new bull market. If I was in a coma and I woke up and I said, tell me two things, and I'll tell you if I want to be long or short the market. Just tell me two things. And you said central banks are raising rates. Earnings estimates are coming down. I would not say, oh my God, those are the conditions of a bull market. Everybody go out and buy. What I want to hear is central banks have started to lower rates and earnings estimates are starting to come up, or at least bottoming out. I would say, there you go, buy. Let's get beta as much as possible. But certainly not in this condition. So I give it less than 5%. Soft landing, less than 40%. Hard landing, greater than 40%. I think, the best estimate I have right now, that if I were planning for something, I would say we're going to have a hard-ish landing. Not quite a hard landing, but not a soft landing. If you do have a soft landing, you're going to be in between two rocks. On one side is inflation, on the other side is recession. And you're going to have to travel between those two rocks for an extended period of time, which means the cost of capital is going to have to move up. Real rates are going to have to move up, and if they do, valuations are going to have to come down. 18.52 forward earnings is simply just too high. Considering that a long-term equilibrium number is 16.6, you're at 18.52. That's going to have to come down. And hard landing, greater than 40% probability here, because once momentum starts going in a particular direction, it doesn't just change. So once the economy starts slowing down and companies gird for a recession, that doesn't just change in a weekend and everyone says, oh, hang on, let's head outside, everything is fine. That has to carry through. And besides, a recession right now would be a good thing. I have had some pushback on the recession thesis. Let me just back up so I can write down here again, saying, okay, let's say you get a recession and you flatten that supply curve. So let's say it goes from this to this so that you introduce slack into the labor market. As soon as the economy started to pick up again, wouldn't it just go right back up again? No, it wouldn't. Well, eventually it would, as you come out of recovery and into expansion, and late expansion would start showing up again, but not initially, because once a company releases employment back out, they tend to, early in a recovery, invest more in automation and software than they do in employees. That usually, after the economy bottoms out and starts to recover, you really don't see employment tick up until later in the recovery, after the company has exhausted other sources of automation. So that in the next cycle up, for the same level of output, you need fewer workers. That's how you introduce slack into the system. So it's got to happen. I think the recession is the quickest way to make it happen, but you have to introduce slack into the system. Okay, back to the ES here. I have June ES. I'm short the June ES contracts. They closed at 41.22. There is 43 points of carry in there from the closing SPX. My average price has moved up to 41.31 because, as I said, when you're short, you must be tactical. You must add and subtract, trade in and out. Keeping your base position, keeping whatever you want, but you must be willing to add to it and subtract to it as the market changes. So I was able to add some points to my total break-even. I've moved my break-even now up to 41.31. Finished at 41.22, so I'm in the money on this one. I had already sold 50% of my position, or sold puts on 50% of my position at 40.50 for 122. I now have added to that. I sold the other 50%. Well, I shouldn't say the other 50%. I've matched this position basically with the June 42.50 calls. So I've sold the June 42.50 calls. I was trying to get 122. I was watching the price saying, when it gets to 122, I'll take it. I'd like to get just the same dollars. I don't know why. There's no real reason. There's no strategic reason. It's just one of those things in your head that you say, yeah, that could be kind of neat. Anyways, I got 111.75. I tried 112. It wasn't hitting me at 112. I lowered it a quarter. Bang, it hit me. So my total premium, because I'm short the call and I'm short the put, is 233.75, which gives me break even to the upside of 44.83. I don't see us breaking 4,500 by June. I am unconcerned with that level. My downside break even is 38.17. So I got to think, well, how do we get to 38.17? Right now, the market seems very well supported on a 20-day moving average, right around 407, and it just doesn't seem to want to get much below that. Even though the move in rates has been substantial enough that it should have re-rated the multiple down to at least 17.5, I would think, but it hasn't. It's held pretty close to 18.5. Below that, we have a 50-day moving average and a 200-day moving average at 396 and 393. You'd have to get through that. And if you got through that, it would open up the December lows sitting around just a little under 380. And if you did break that, it opens up the October lows, the late October lows, and the early October lows here, which I don't know that we can see that just yet. But you got to break the 20. If you break the 20, you got to break the 50. Then you got to break the 200. Then you got to break the December lows. Well, I'm at 381.17, which is just above the December low. So I think I'm okay there. Look at the delta that I got on that. The puts give me negative 0.414 delta. The calls, I'm adding delta, and since I'm short, you have to actually. The puts have a negative delta, but I'm short, which gives me positive, right? The calls have positive delta, but since I'm short, it gives me negative on this. So I have positive delta here, negative delta here, 0.022, almost neutral on these. So these calls have neutralized these puts. I'm back to my just original short position on ES. So I basically got two positions here, a short position on ES, and a short strangle on ES as well. If we do get to 38.17, so this is the thinking that I go through. Well, I don't lose anything. 38.17, this position, this strangle breaks even, and then I start losing on half the position, but I have the full position all the way down from 41.31 to 38.17. I can cover 50% of my position. Take profit, and the other 50% would cover off the short puts that I have, and there it is. I'm hedged right out. So this allows me to stay in my short position much longer than I normally would. If I were just short ES without anything else, right around the 50 or the 200 day in the low 390s, I might think about covering. This allows me to stay in the game a little bit longer. Implied volatility is flat week over week. I'd like to see it get a little bit higher because there's more value in the options when the implied volatility is higher. But, well, there it is. I would continue adding to the short position, by the way. On any rally, I think I would just add more to my June ES contracts. Friday's put call ratio 1.23 just on Friday. The open interest is 2.18 versus 2.11 last week, so a little bit more on the puts. Last implied volatility 17.9 versus 18.7. I find it odd that two things are going on here. Volatility just doesn't seem to be increasing. It just doesn't seem to be responding that much. And the multiple just doesn't seem to want to re-rate based on the higher for longer narrative that the bond market seems to be accepting. At some point, that cost of capital has to start reflecting that your risk-free jump-off point is over 5% right now. Not 0.2%. I mean, if we're thinking about using a 3-month rate or even a 1-year rate, if you were doing a 1-period equilibrium model, you would use a 1-year rate. If you were doing a long-term model, you might be using the 20-year, but the 20-year is going to be elevated for some period of time. Probably not the 20, but we'll say the 10. The 20 has an odd kink in it, so I don't know that I would use the 20, but the 10 is significantly higher now than it was 2 years ago. Yet the cost of capital doesn't seem to want to quite reflect that at this point, because if it did, that forward multiple wouldn't be 18.52 in a low growth environment. So I think the equity market is just being a little bit slow to catch up with this, but it will, unless the bond market has it wrong. and the data starts coming out and showing that no, inflation really is going down. The economy really is as strong as what retail sales is showing and what the job market is showing, and everything's going to be just fine. And the Fed starts signaling that, hey, maybe the job is done. Maybe we only have to go another 25. Maybe the bond market has it wrong. I don't seem to think that that's true. The other reason why I'm holding short on my beta and probably increasing has to do with margins. Is you have profit margins, which is a mean reverting series. If you look at the share of GDP, if you take the corporate profits and divide it by GDP, the share of corporate profits in GDP, it has a long history of being a mean reverting series. Now, there is some question as to whether it has gone to a new level. 6% used to be the long-term mean reverting level for that ratio. But in the last 15 or 20 years, it has gone to a newer level. It's hard to pull apart whether that is due to the opening up of trade we've seen over the last 20 years and the shifting of some parts of the value chain to lower cost areas that increase margins, or whether it was due to the sheer massive amount of liquidity that central banks around the world flooded markets with. It's hard to pull apart which one exactly it is. But we're sitting at around 12%. And if we accept that 6% is the mean reverting level, that's a long way down. I'm not in that camp of saying that 6% is the level, but I do think at this new level, maybe we are in a new regime for that ratio. I think 12% being the top of the series, given that over the next 3, 4, 5 quarters at least, central banks will be raising rates and draining liquidity, and earnings estimates are coming down. I can't see those margins holding. So I do think that there is going to be downward pressure on margins. I think we are in a low growth environment until we have a recession. If we want a high growth environment, we got to clean out all the excess. You have to have a recession, and you have to have companies that refocus on efficiency throughout the entire company, and that rebuild their companies for the next wave using a lot more efficiency rather than labor, automation and software. Otherwise, I don't see it happening. I think it is healthy for a body to get sick every now and then, just to clear it out. Think about it in this particular way. The best analogy I can give of why we would need a recession to get stronger growth rather than just a soft landing and then grow from there. And I'm going to use a gym analogy here. It is very common, over time when you go to the gym, you'll see gains, and then your gains start tapering off, and then you plateau. I'm sure you've heard that word, plateau. And then for a period of like 2 months or something, you just can't seem to make any gains. The way to make gains is take 2 to 3 weeks off. Just stop going. When you go back, you'll be here, but then this is what's going to happen. You'll breach that last level and you'll hit a new plateau. I think the economy has to do the same thing. Take 2 or 3 quarters off and then come back in, and you can grow past that point where you've plateaued, because we're plateauing right now that if you go any higher, you hit inflation. If you go any lower, you have recession. So let's just do it. Let's just get it out of the way. So that's where I am. I am now net short beta because I've eliminated the short puts with the short calls. So now I just have this. I still have long positions. Canadian REITs have still performed very well throughout the week, even though rates were rising in the US. I guess it's trading on its own yield curve. That I've been slowly reducing my position in REITs. I had sold IYR calls, and as of Friday, I was going to let them expire and take the short position, but Friday was really nice on the IYR. It came down under $90. Put my puts, my sold calls, in a small profit position. I sold the 88s for like 288. I was able to cover, I think, at 210. Not much, but I rolled them over, not only to the 88s from March, but down to the 86s. So I closed those and opened up 86 calls. So I've sold some in-the-money calls on IYR. only because I'm still long REITs. So if I mess up on the REIT position because I didn't take my profits when I should have, and the REIT sector drops, I will cover it off with the IYR because I'm short the calls on the IYR, so I'm sort of hedged out there. On the currency front, I'm still long the yen. I think the market is undecided as to what the new Bank of Japan governor will do, Ueda, of what he will do. But the belief is that they will have to abandon yield curve control at the 10-year. And if they do that, the yen will rally. It's a small position, but it is working against me. My average is 129. We're at 134 and change, so I am underwater on that one. But it's small enough that I don't really have to worry about it. I think for 2023, my year will be made with beta and duration. I'm fairly confident that I just really have to stick at the level of beta and duration without getting too involved in particular names or stock picking or doing any of that. I think that those two big factors, just the big factor exposure on their own without having to dig around, I think that will really make my year. Okay, let's look at the calendars. Okay, we'll start with the economic calendar. We can see here Monday is a holiday. It's also a holiday in Canada, so Monday nothing is going to be going on. Currencies will still be trading, but don't expect a lot of liquidity in them. And I believe futures markets are still open, but don't expect a lot of liquidity in those either. Tuesday, you have PMI numbers coming out and existing home sales. Wednesday's the big day, the FOMC minutes at 2 p.m. I will do a separate video just for the minutes because they can take up to half an hour just to get through the minutes. Thursday, we get a second look at fourth quarter GDP. And then Friday is PCE, Personal Index and Outlays. That is the Personal Consumption Expenditure Index. Along with it, you get the Personal Consumption Expenditure Price Index, which is the PCE. New home sales at 10 and consumer sentiment at 10. So Wednesday is a big day and Friday is a big day because, well, this is the Fed and this is inflation. And that's really all that matters. The week after, jobs. We get to see what February was like with the March jobs report. That's going to be watched a lot because was January an anomaly or is there something really going on there? If that comes in as a big number, oh boy, I think you could probably start to see, revisiting of the December lows at that point. For earnings, here it is right here. This is 220. February 20th to the 24th. This is next week. You have 62 issues, but I think 3 of them are Dow components, or 2 of them are Dow components. I'm not sure. 2 of them are Dow components. Sorry, so you do have actually 60 that will be reporting. And here is the list. Home Depot. That'll be interesting. That's on Tuesday. And this is Tuesday before the open. ATC is after the close. So you can, I'm not going to go through each of these and read them off. You know where to get the spreadsheet now. The link is in the description box. And of course the second category here is what sector they're in and then what sub-industry they're in. So if you're only interested in certain sub-sectors like consumer discretionary, just to see the strength that's where you see the strength of the consumer, by the way, is in consumer discretionary. Then you can at least be aware of when they're going to report. Beyond that, the game doesn't start till Tuesday morning, and with a warm up and the main event on Wednesday, followed by another main event on Friday. Day to day, data point to data point. I really would like to move past this. I don't know about you. That's it.